Coming up on Market to Market, who can own U.S. farmland goes under the Senate microscope. Vertical farming has grown while fending off challenges. Making sense of the swings in fertilizer pricing. And market analysis with Ted Seifried next.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next, because at Pioneer, our name is our mission.
Sukup Manufacturing, celebrating 60 years of innovation as a family-owned and operated manufacturer of grain storage, drying, and handling equipment out of Sheffield, Iowa. Learn more at sukup.com.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
This is the Friday, September 29th edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. One beacon of positive light in the housing market has been the sale of new construction. Not anymore. Higher interest rates may finally have cooled this sector as the August rate dropped 8.7%. Another long-term purchase, durable goods, moved 0.2% higher last month. Higher defense spending led the sector. The government's preferred gauge on inflation rose by 0.4%, below expectations. When the core PCE is measured, the gain was only 0.1%. The Senate passed a continuing resolution to keep the government open this week, while the House approved some spending bills. But as of this taping Friday, no deal has been reached to keep the government open past Saturday night. The Senate Agriculture Committee did hold a hearing on the issue of U.S. farmland ownership. More than a dozen states have enacted some legislation on this very topic in 2023. But as the committee heard, the nationality of the biggest landowners is already in North America. Here's Peter Tubbs with this report.
Deterrent space systems.
The Senate Agriculture Committee met Wednesday to discuss the rate of purchases of farmland by foreign entities and questioned witnesses over the security risks of American farmland being owned by the Chinese government. While only 3% of the 1 billion acres of American farmland are owned by foreign interests, roughly the size of the state of Iowa, that percentage has increased 50% in the last 10 years. Most of the foreign owners reside in Canada and Europe. Less than 1% of the foreign-owned land is under Chinese control, with Smithfield Foods holding 80% of China's share. In accordance with the Agriculture Foreign Investment Disclosure Act of 1978, the Department of Agriculture collects data on land ownership, but the reporting process is voluntary.
We've been working to address consolidation efforts and have a collaboration with attorney generals throughout the country to be able to address that. With regards to AFIDA, AFIDA itself is a disclosure act, and that is the authorities that we have. USDA does not have the authority to approve or decline purchases of land, domestic or foreign.
Experts testified that while China has significant investments in American agriculture, farmland has not been a target.
By and large, China's foreign investments in farmland have bypassed North America. They're really looking at acquiring agribusinesses like Smithfield. We saw ChemChina's takeover of Syngenta. And this is to exert more control over their import food supply chain. And I do foresee there being additional investments in this regard. But when it comes to actual American farmland, it's not something that I would consider as part of their current foreign investment strategy in agriculture.
For Market to Market, I'm Peter Tubbs.
Humorist Will Rogers was quoted as saying, "Buy land, they ain't making any more of the stuff." Where it comes to food production, a growing population and a limited supply of land has more than one entrepreneur looking for a foothold. David Miller has the story.
As the world's population runs past the 8 billion mark, there have been concerns about how to sustainably feed an ever-growing number of people.
One of the answers may be vertical farming. The concept of growing food upwards inside a building instead of outwards across the ground has found more than one entrepreneur taking a chance on what they hope will be the future of farming.
We're just trying to supplement something that we recognize is already an issue. So I think that moving forward, that sustainability has to be a conversation, regardless of where we're growing our food.
Vertical farming touts several advantages, including reduced water use, optimal growing conditions, and a consistent, reliable output, often in areas far from the farm, reducing the miles fresh food must travel to get from field to aisle. Several independent business owners with deep pockets have made the investment. California's Plenty is breaking ground on a $300 million facility. Big supermarket chain Kroger has expanded their vertical farm offerings. However, several startups have encountered distribution or operating hurdles that force them into bankruptcy. There are those who believe vertical farming is a detriment to the environment, and the financial resources could be devoted to improving horizontal farming. Tom Kimmerer is a plant physiologist who taught at the University of Kentucky.
We are missing out on enough investment money going to more traditional farming. There's a huge opportunity to invest in traditional farming to increase productivity, reduce the carbon footprint of farming, increase the nutritional quality.
Like any leading-edge business, vertical farms still face the same hard realities as their land-based counterparts, constantly looking for the right mix of capital and customers for their businesses to succeed. For Market to Market, I'm David Miller.
Two major factors drove up the fertilizer market in the last 2 years. Now, those waves have calmed, but the question remains. Are the worst of the high prices behind us, and what could return quickly to change the market? We put these questions to Josh Linville, the Vice President of Fertilizer for StoneX. His comments are part of an upcoming MTOM podcast and is this week's cover story.
I would say the leading one was the Russian invasion of Ukraine, which a lot of people sit there and say, oh, well, that must have really hurt Ukrainian fertilizer exports. And that's not the case because Ukraine is not a major exporter of fertilizer. What happened, it was a secondary event. Russia, upset with Europe, but first on the Nord Stream pipeline situation, and of course their support of Ukraine, stopped shipping natural gas to Europe. European Dutch TTF values started to skyrocket. All of a sudden then we had, the price of the input was so high, they could not make nitrogen fertilizer, and it disrupted global supplies. That to me is the single biggest event, just because it wasn't a direct fertilizer situation. It was one of those secondary events that had a major impact on the fertilizer markets.
So now, Josh, we sit here and look at the market and say, okay, we still have Russia trying to invade Ukraine, still there. That issue hasn't gone away. China's having, whether it's an up or down economy, you pick what service you want to believe. And we've seen a relaxation in most of the fertilizer prices. Why?
We have normalized a lot of the situations. To your point, the Russian stoppage of natural gas flows to Europe. At first, that was a major event. Oh my gosh, what are we going to do? We're going into winter. There's not enough supplies. We saw that Dutch TTF go from $4, $5, $6 in MMBTU to 103. Today, 15, 16 bucks. Are we back to absolute normal? Absolutely not, because the world is still messed up. But we're not back at that high end because we figured out normal. We figured out imports and exports and things like that. An open and free market finds a way eventually. There's always going to be a little bit of a scary period there where all of a sudden everybody's like, oh my gosh, I don't know what's going to happen. And fear generally drives prices higher. But as we start to figure it out, and that's what's happened around the world, we figured out, oh my gosh, we thought we were losing Russia. We didn't lose Russia. Oh my gosh, Europe will never turn their nitrogen production back on. About 75, 85% of their production is now online. So all these events that we're scared of, we figured out.
But did we also use less product?
To a certain extent, yes. High prices cure high prices. Demand always ends up having to say in the S&D, right? So yeah, there's a little bit of a scaling back, but ultimately, this seems as though it was more of a rationale of the new world. to me at least.
So what's going to be the big driver now then on the volatility?
Well, right now it depends on the market. When we look at nitrogen, a lot of it is centering around China again. The government continues to sit there and step into the export market, making dictations. You can do this. You can't do this. Right now, the big fear of the world is the government came out and said, we need to fill Chinese warehouses first. We are going to stop exports. Well, then we started to find out it wasn't exports to the rest of the world. It was exports to India. They're really zeroing in and saying, we're going to slow down going to India. So that's disrupting global supplies, global trade. On the phosphate, it is dodging two bullets. You know, that major hurricane that went up through the Gulf of Mexico and went just north of Tampa, that thing missed a lot of phosphate production by a hair. And then the earthquake in Morocco, right? A huge devastating effect on the population. Fortunately, the phosphate production kept on churning along. So it's missed two major bullets, but still dealing with very, very tight supplies here in the U.S. Countervailing duties are keeping three of the world's largest global exporters from accessing our country.
We're already looking ahead. I'm already getting questions about 24 acres. You're making a decision to plant corn or beans now if you're applying anhydrous. So you're anticipating more fall application, henceforth, more corn acres, right? Or am I reading too far down into the book?
We are forecasting right now in our demand models, we are using 92 million acres of corn and 88 million acres of beans next year. Now that is actually a little bit less corn acres than what we did this year. However, last year, anhydrous is a little bit overvalued, and we didn't quite know there was going to be 94 billion acres, right? We didn't lead into the season thinking it was going to be that much. But as we look at it, we actually think that anhydrous is going to take more of the overall nitrogen demand, assuming Mother Nature allows it to get out there, because it has been so well priced. Right now, we're forecasting that fall anhydrous is going to be great. It's going to be 2.15 million tons applied. Well, what happens if it's November 1st and it finally starts raining? That's great for the Mississippi River. That's terrible for anhydrous application. Then what else falls in snap freeze? And we can't run toolbars anymore.
I guess I'll ask one more weather question. When you see areas come out of drought that traditionally are in drought, I'm thinking of areas south of you and west of you that have emerged, and then the areas around me that are in drought and don't look anywhere close to emerging. Does that have any influence on what you do?
Absolutely. And it's having the conversations with our clientele in those areas, it gets very difficult. Because put yourself, obviously, a lot of folks are listening in from a farmer's perspective. It's hot. It's dry. What's your approach to it? I'm not putting anything on this ground. I'm not going to plant anything. If there's no moisture, it's stupid. I'm not going to spend the money. So your feedback to the retailer, I'm not going to buy. I'm not going to buy. I'm not going to buy. What happens when the first rain comes through? Well, I need to buy. The retailer's sitting there saying, you sat there and said you weren't going to need anything. Every farmer in the area was saying, you weren't going to need anything. I wasn't going to take that price risk. So now all of a sudden, demand goes from 0 to 100 mile an hour in a matter of a couple hours when a rainstorm comes through. So and all of a sudden you start trying to figure out those regions. You can have an overall market that's falling through the floor. But if that region is sitting there desperate for whatever it can get its hands on, that number can actually start to rise. And those are the little opportunities or the risks that we look for.
The full discussion will be part of the MTOM release on Tuesday.
Next, the Market to Market Report.
Friday's quarterly stocks report failed to add any positive news to an already challenging week as the government raised piles of wheat and beans, and also government crop surveyors started as the shutdown loomed. For the week, the nearby wheat contract dropped 38 cents, while December corn lost a penny. The soybean trade looked at longer moving averages for guidance. The November contract fell 21 cents, and December meal shed $4.60 per ton. December cotton expanded by $1.28 per hundredweight. Over in the dairy parlor, October Class 3 milk futures decreased a quarter. The livestock market was lower. December cattle lost $3.42, November feeders cut $8.63, and the December hog contract declined 40 cents. In the currency markets, the U.S. dollar index added 53 ticks. November crude put on 47 cents per barrel. COMEX gold lost 79.60 per ounce, and the Goldman Sachs commodity index shed almost 3 points to settle at 608.70. Joining us now, regular market analyst Ted Seifert. We're going to need a whole lot of your smile to get through this week, Ted.
I know, right?
I mean, this wheat market alone,
Yeah.
Let's see, KC Hard Red looking at old lows, Spring looking at 2-year lows. Where's the silver lining there?
Oof, I don't know. You know, and actually the week for wheat wasn't all that bad until Friday, right? And you have a production report that comes in 80 million bushels higher than what expectations were and what last month's USDA numbers were. That really threw a wrench into the market and really did some technical damage. So now you hope those lows hold, but they are going to be that target. That's the next hope that we have for wheat.
Hope is only one thing. So we're looking at almost 7% on the December contract. So quickly on wheat. I know you're going to have to, you get asked this a lot on Twitter. Is this the bottom?
Yeah, I do get asked that a lot. So unfortunately, I don't think so.
Okay.
And I think that really ties into what we're going to talk about in the row crops too. We have macroeconomic things that are afoot. And that I think is going to really impact seasonality. It's going to impact, technicals and charts that we think, hey, these are levels that should hold. I think they skew fundamentals a little bit, or our perception of fundamentals a little bit. So unfortunately, I have to say no.
Corn, not much better.
Right.
But only not even a penny, so even on the week, but it was quite a week. Started out with some incredible news that Mexico bought a whole bunch of grain, and then it didn't get any better.
Actually, all the way up until Friday morning, corn was having a good week. We were up, I think, 11.5 cents for the week or so. And then, yes, we gave it all back on Friday based on the report, based on the massive risk-off situation that you had, really commodity-wide, stocks as well. I'm going to say there are some things that I think are turning a little bit more positive for corn. That is, that big export sale to Mexico. The last couple of weeks of weekly export sales have been fairly solid, and we know next week's going to be really good because of the Mexico sale that we had on Monday. Ethanol's hanging in there pretty well. It'd be great if we could get unleaded gasoline consumption to start moving higher. It's still languishing around end of pandemic levels. So that's the one drawback for ethanol, but margins are good. So we're going to continue to push ethanol. So that's good. The problem, though, is we're still looking at a potential 2+ billion bushel carryover, even with quarterly grain stocks numbers coming in a little bit below expectations. And that quarterly grain stocks number, while that was lower than expectations, and stocks year over year are down 1%, the on-farm stocks are up 19%. So when we talk about looking for harvest lows, that means that most of the cash pressure, the cash sales that are going to happen leading up to and during harvest are behind us. You cannot comfortably say that right now. There's going to have to be a bunch of old crop that has to move in order to make room for new crop. And I've got a fair amount of guys that are coming back and telling me that they're finding more bushels out there than what they were expecting. So there's unaccounted for bushels that are now going to be on the sales sheet. So yeah, harvest lows in corn, we want it to seasonally be now. That this should be now, but it doesn't. I don't think the fundamentals are there for it. And again, the broader market picture, I think, is a big problem for corn, for commodities as a whole. And I think it takes away some of the seasonality that we would expect for corn.
We need those names and numbers of each individual customer that says more and where they're at. Okay, corn, one last quick thing on it then. If the low is not there, if there is more grain out there, and the report validated the thoughts of there's a whole lot of corn still on the farm. So my question to you is, do you take a loss as much as you can and sell off the combine right now?
So, the good thing is that we have crop insurance and the levels were set at decent levels. I mean, look, none of this is fun, right? This was the most expensive corn crop we've ever planted. And if you had not made sales throughout the year when you had chances to, this is a tough decision to make. And I understand how hard it was to make those sales when we had those 2 spikes during the growing season, because then you're sitting there thinking, well, it might not ever rain again. We might not have a corn crop. Corn could be going to $8. Yeah. So it was difficult to pull the trigger. And if you're sitting there now, I think what you have to do is make the sales, take the crop insurance, but you almost have to protect the crop insurance at this point by, say, owning calls.
I'm looking at technicals in soybeans, looking at that 100 and the 200-day moving average. Is it telling you the low is in, or it's time to make a sale before it turns lower?
I hate the look of the soybean chart right now. It looks really toppy from a long-term perspective. We broke out below that 1280 level in November beans on Friday. That is a really bad look. That looks like the start of a new leg lower. I think the immediate target is 1257, but 1180 is kind of the projection at the moment. So I know I'm not the bearer of good news here, Paul, but Friday was a really not good day for really everything. From a chart perspective, bad day.
So, I guess same question as it was in corn. Do you think this will force some people to sell before it gets worse?
I think for soybeans, you really have to do that. You know, look, corn has been just hovering right above and consolidating sideways right above the lows for a month and a half, right? So the soybeans are well off the lows. You know, we had 1120 before we got the acreage report back in May. So we're 13, well, we just got below 1280, right? So, I mean, we were at 13 for a while. We're not far off 13. If you go further out in time, you are still seeing some contracts at 13. These are still relatively decent prices in soybeans. I think you really do have to take advantage of that.
Okay, we're showing that March contract, and that's exactly what you're talking about, 1310. I need to get to livestock because that, too, was not real pretty. You mentioned the macro markets, outside markets on cattle. Economically, those are always tied together. Do you see that that is more independent, the cattle market's topped, or is that influenced by outside markets right now?
So you have a lot of speculators that have been trading in the cattle market, and when you have a massive risk-off event, they're going to run for the doors. In the meantime, it does chart damage. That gives them more reason to sell. And you've got a lot of fear and concern about what's going to happen with government shutdown, but also the economy going into fall and winter. Some are suggesting this could be this could be the recession that we've been talking about for years that hasn't actually happened. So there's a lot of fear surrounding the cattle market in particular. I don't know, the supply side fundamentals are still are pretty bullish, I think. It's just a matter of if we do go into this economic slowdown, we're not going to be able to support paying for high-priced beef.
Right, and so then the feeder volatility is there too, given it's shown some volatility. However, can you find some hope that since we're short animals, that might stave off some losses?
The biggest hope in the feeder cattle complex or feeder cattle is that we've done enough of the work already, right? And you have the potential for lower corn prices coming. So those two things, I think, could be fairly supportive now that we've broken $15 off the highs or so. The problem is that when you're looking at feeder cattle, you're looking at further on down the line, and our recessionary fears are further down the line. So that's why it hit feeder cattle first and the hardest. But at this point, yes, we've gotten very oversold. You'd hope that we're close to finding a bottom and at least trying to consolidate and maybe bounce back a little bit.
Hogs and pigs report on Thursday, and the wildness continues.
The California deal is just lingering. That's just a bad deal. The good thing about hogs, though, is that if we are slipping into this recession, that we were so worried about and have been for the last, look how bad the stock market has taken a hit just since the beginning of August. It's not good. And the dollar is just flying high. The winner here might be the hogs, because if we are going to the grocer and saying, you know, hey, we really need to cut back a little bit. Let's not, spend on the T-bone. Let's get some pork chops instead. As a substitute protein, pork could be the winner here. So I think a lot of the negative news for hogs with California and everything like that has been factored in. I want to be friendly hogs, especially if we are going to be so negative on everything else. I just don't like the strength in the back months, because I want to own further out in time, but I'm owning at higher prices, and that makes me nervous compared to what we're trading at in the front months. So, I want to be optimistic for hogs in a recession if that's where we're headed.
We tried to smile as best we could, Ted. I know. We're going to answer some more questions here in Market Plus, and maybe we'll find something positive there. All right. Thanks, Ted.
Yep. Thanks, Paul.
Hold on there. We are going to pause this analysis, continue our discussion about these markets in our Market Plus segment. You can find both analysis and plus on our website of markettomarket.org. Our portability keeps you in the loop and us in your cab, truck, or ears this harvest season. Follow our YouTube page for full shows, Market Plus, and the MTOM podcast. Hit subscribe at youtube.com/market-to-market. Next week, we look at farm safety when entering the bin. Thank you so much for watching. Have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next. Because at Pioneer, our name is our mission.
Sukup Manufacturing, celebrating 60 years of innovation as a family-owned and operated manufacturer of grain storage, drying, and handling equipment out of Sheffield, Iowa. Learn more at sukup.com.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.